Thinking of investing? Pause for just a moment. There are some uncomfortable truths about the market that most so-called experts won't tell you. The darker side of investing, the part that could shape or shatter your financial future. Nearly 90% of day traders lose money. The average investor underperforms the market by close to 4% each year. And trust me, you don't want to become part of those statistics. So the real question is, how do we keep you from falling into these traps? Stick with me. And if this is your first time here, make sure you hit that subscribe button and tap the bell icon. This channel covers these topics all the time, and it'd be a shame if you missed videos that could potentially protect your portfolio. With that out of the way, let's dive in. Fact number 1, investing is more of a mental battle than a numbers game. When people hear someone invests in the stock market, they usually say things like, "You must be amazing with numbers," or "You must be a math wizard." But nope, not even close. The reality is investing is maybe 20% numbers and 80% psychology. The math? A 10-year-old with a calculator could do it. The true difficulty isn't in calculating PE ratios or dividend yields, it's controlling that inner voice screaming, "Sell everything, the market just dropped 3% today." Or resisting the urge to throw all your money at a stock that shot up 300% just because social media insists it's headed to the moon. Almost all of us understand in theory that you should buy low and sell high. Yet study after study shows the average investor does the exact opposite. Why? Because fear and greed hijack our decisions. Take March 2020, when markets crashed at the start of the pandemic. On paper, it was a once-in-a-lifetime buying opportunity. Psychologically, though, it felt like financial suicide to buy stocks while the world looked like it was collapsing. The winners? They were the ones who kept their emotions in check while everyone else panicked. So before obsessing over spreadsheet models, ask yourself, can I stay calm if my portfolio tanks 30%? Can I resist the hype of a stock everyone's talking about? Can I stick to my plan even when everything feels like it's crumbling? These mental tests will matter far more for your investment success than any compound interest formula ever will. Fact number 2, you will make mistakes. Lots of them. Not maybe. Definitely. It doesn't matter how many books you've read or courses you've taken, mistakes will happen, and they'll cost you money. Even seasoned investors with decades of experience still mess up. They've bought at peaks, sold great company early, clung to losers too long, and overlooked obvious opportunities. What separates the successful from the unsuccessful isn't some magical ability to avoid errors, because avoiding them completely is impossible. What matters is how they react when those mistakes happen. Most people go one of two ways: either they beat themselves up and lose confidence, or they deny it was even a mistake, which means they learn nothing. Both approaches destroy portfolios. The truth is, mistakes are like tuition fees for your investing education. The only question is how much you'll pay and what you'll learn. The costliest lesson is when you keep repeating the same mistake because you refuse to learn the first time. Those who complain that the market is rigged or that investing doesn't work are usually the ones who never learned from their own errors. So what should you do instead? Be brutally honest with yourself. Was it your strategy? Did emotions cloud your judgment? Did you ignore the warning signs because you were blinded by potential gains? Yes, it's uncomfortable, nobody likes confronting mistakes. But in investing, that kind of honest self-reflection is far less painful than repeating the same costly errors again and again. Fact number 3. Taxes aren't the enemy. Yep, this is your reminder to pay them. Better you know this now. Many people fear taxes so much they end up making choices that hurt their net worth. Think of it this way, taxes are simply the price of making money. If you're paying them, congratulations, it means you're winning. Taxes only come when you profit. But I've seen investors hold onto a stock that's up 500% just to avoid capital gains, only to watch it crash and leave them with far less than if they just sold and paid the tax. Others avoid great opportunities entirely because they hear there's a tax issue. Here's the truth, while tax efficiency matters, avoiding taxes should never be the primary driver behind your investment decisions. What actually matters is your total after-tax return. Ask yourself, would you rather earn $100,000 and pay $30,000 in taxes ending up with $70,000 or earn $50,000 and pay $10,000 in taxes ending up with $40,000? A bigger tax bill can actually mean a better outcome for you. The best investors out there get the tax side right. They use tax-advantaged accounts like 401k, or IRAs, and they focus on smart investments, not just tax avoidance. Fact number 4. Constantly hopping between strategies wrecks returns. And yet, that's exactly what most investors do. The investing world is packed with flip-floppers, people who jump from growth stocks to dividend plays, to value, to crypto, to whatever's trending that month. Every time, they abandon their old approach before it has time to work, convincing themselves the new one is the one. What happens? They buy growth stocks at peak valuations, panic sell when prices dip, then shift into safe dividend stocks. The moment the market roars back, they ditch dividends for the next big trend. Every switch happens at the worst possible time, buying high, selling low, again and again. Do you think Warren Buffett became the world's most famous investor by constantly changing strategies? Not a chance. His style evolved, sure, but the core principles have stayed consistent for decades. During the dot-com bubble, everyone mocked him for avoiding tech stocks. But when the bubble burst, people suddenly remembered why Buffett was called the Oracle of Omaha. Look at any great investor, they don't usually have flashy or trendy strategies. What they do have is consistency. They pick a solid approach and stick to it through good and bad. Consistency almost always beats trying to optimize every little thing. Now, refining your strategy as you learn is fine, that's growth. But abandoning it altogether? That usually just means you're chasing performance. Fact number 5, the financial industry thrives on complexity. Why? Because complexity can be packaged, marketed, and sold for higher fees. It makes sellers look smart and lets them justify charging you more. But the truth is simple investment strategies often outperform complex ones long-term. Study after study proves it. We've all met that person who has spreadsheets filled with 17 technical indicators, rotation schedules, and advanced option strategies that require a finance degree. They're glued to their computer for 20 hours a week and still get beaten by plain index funds. Funny, isn't it? The people who've actually built wealth tend to keep things surprisingly simple. Diversify. Keep costs low. Invest regularly. Be patient and let time do its work. But here's why this makes people uneasy. We all want to believe there's some secret formula or hidden pattern that gives us an edge. Some complicated system that guarantees better returns. But there isn't. Markets are too unpredictable and too efficient for complexity to consistently win. Not what you want to hear while studying your Investing for Dummies guides, right? Fact number 6, not all risks are the same. Some risks bring potential rewards. Others are just Russian roulette with your money. The truth is, you have to take risks if you want your wealth to grow. But you must be selective about which risks you take. Ever notice how some people claim the stock market is too risky, then dump their money into some random crypto token just because a YouTuber said it could 10x? That's like refusing to swim in a pool because you're afraid of drowning, then charging into the ocean during a hurricane. What actually matters is knowing the difference between smart risks and reckless gambles. Smart risks have reasonable odds, fit your strategy, and don't risk too much of your capital. Reckless gambles? Unknown odds, pure speculation, and often money you can't afford to lose. Fact number 7, comparing returns to others will destroy you. We've all done it. And with social media, it's out of control. Scroll for 5 minutes and you'll find people bragging about 1000% gains or perfectly timed trades, but comparing yourself to others is a straight path to failure. Those posts, they're highlight reels. Nobody's showing you their losses, and when gains are real, they're usually just lucky timing, not skill. The result? People abandon solid strategies that are working for them because some stranger on Reddit claims to be doing better. That's a shortcut to disaster. The only question that matters is, are you on track to meet your personal financial goals? That's it. Not whether you're outpacing your brother-in-law or some influencer's claimed returns. Successful investing is personal. Learn from others, of course. But don't measure yourself against their carefully curated highlight reels. That's a game you'll never win. Look, these aren't things you'll hear from the gurus peddling get-rich-quick schemes. They're not flashy. But if you understand them and apply them, they work. Stick to these basics, and you'll already be ahead of most investors. Thanks for watching. If this helped, hit that like button and subscribe for more no-nonsense investing talk. Until next time.